Holding cash is a financial death sentence. At least that has been the case for 20 of the last 25 years. These 5 out of 25 years, or more accurately, 3 periods of time where cash was king, can actually tell us a lot about the state of the economy and what is potentially around the corner. Trillions of dollars are constantly on the hunt for gains, which creates periods of cash as king, risk on, and defense. These market cycles are what we'll pull apart in today's video, where I'll also share why I believe we're on the brink of a massive risk-on environment. Quick disclaimer that I'm not a financial advisor, so always do your own due diligence and research, and past results are not indicative of future performance. And also, if you are brand new to this channel, I'll leave a link in the top of the video description where you can subscribe to our free economic report, our Trader's Edge, and also Bitcoin updates. Our analysis and outlook across the economy will be hitting your inbox very soon. It's completely free, so go ahead and drop your details in the link in the description below. Now, in the last 25 years, there have only been 3 periods of time where holding cash actually made sense to do so, and the returns in cash outstripped that of our traditional assets. For the rest of the time, any money held in your bank account was losing value against everything else going up. We have inflation, and then we just have the general ups and downs of the markets. But more often than not, 20 out of the last 25 years, that money is better put to work in the market where it's going to appreciate with not only the general inflation, but also the expanding economy and growing business activity. What can these periods of time tell us about the market when cash is outperforming other asset classes? Well, we need to add another couple of markets to the equation to paint an overall picture, which is where gold and the stock market are of critical importance. So I'm going to get back to these charts in just a moment, but first I want to walk you through this chart here, which does look relatively busy, but I will pull it apart for you so you can understand exactly what is going on. We're looking at well over 25 years of data and looking at the flow of money between the US dollar, gold, and the stock market. And of course, Bitcoin now plays a part in this too. But as Bitcoin is a newer asset class, we do not have as much history to go on. But when we're in an inflationary or risk-on environment, Bitcoin is certainly going to do well. But for the purpose of this discussion, we will be keeping it to the US dollar, the S&P 500 as a proxy for the overall stock market, and of course, gold. So just like I showed you with over 25 years of US dollar history, there's only been 3 periods where the market has actually gone up. But when we layer that on top of what gold and also the stock market is doing, we can paint an overall picture as to where funds are flowing and where people are chasing those gains. And we can also get a leading edge as to what is around the corner. But just to take a step back, I will explain what these different phases of the market are. Now, when the stock market and gold are going up, we can consider that as a widespread inflationary period. You can see multiple times this has taken place over the last 25 years, and you can really just see how clear the pattern is when both stocks and gold are going up. It's just considered as general inflation as opposed to a risk-on environment. And the reason for that is because gold is typically considered a defensive asset. So when we're seeing gold and stocks go up at the same time simultaneously, it's more so considered an inflationary environment. And of course, this is overly simplistic. Now, I understand that there are a lot more moving pieces to the puzzle in this, but I am just breaking this down for you and just stripping it right back to give you some simple examples and tie all of the pieces together. Now, what I consider a risk-on environment, a genuine risk-on environment, is when we see money flowing out of gold and the stock market continuing to rise. You can see these periods taking place back from 06 and into 07, where gold was falling and stagnant, stocks were rising. That's considered risk on, or what I'm considering risk on. You can also see this taking place from 2011, where gold was falling and stocks were rising, giving us a risk on environment, a genuine risk on environment. And also back from 2018, gold falling, stocks rising. This is what I'm calling genuine risk on. A defensive environment is when stocks are either stagnant or falling and gold is rising. You can see this taking place in many situations over the last 25 years. People are flooding out of their stock positions and moving into gold in the fear of something much worse happening. Whether that worst thing happens or not is besides the point. You can see what the money is doing. That's what we've been seeing lately, with the stock market falling and gold ripping onto new all-time highs with a lot of upside momentum and volatility. Prior to this, we've been in a widespread inflationary environment when most assets have just been going up regardless. Now, the thing with these market cycles is that it doesn't necessarily move from one to another in a set order. The cycle can flip from inflation to cash, back to inflation to defensive. There's no set repeating rhythm, but we can get clues when we start to pull apart the individual asset classes and look for strength and and weakness, which is what we'll be doing in just a moment. I'll share with you the formula that I track to give us an insight into what is more likely going to be the outperforming asset class, cash, stocks, or gold, and we can also throw Bitcoin into the mix when we're considering a genuine risk-on environment. And a genuine risk-on environment is what I believe we're heading into after this defensive period comes to an end. It appears that we have a 20-year repeat going on where we saw the same thing happen with gold outperforming massively and the stock market underperforming. In this case from 20 years ago, the stock market wasn't necessarily dumping, but it was very stagnant, and we did see a sharp rise in gold, much like the sharp rise in gold we've been seeing lately. Following this defensive period from 20 years ago, we went into a genuine risk-on environment. Now this is pre-Bitcoin days, but what we did see was gold start to fall off a cliff and then go stagnant for a period of time while the stock market took all of the gains. This genuine risk-on environment is what I believe we have coming up next before flipping back into full defensive mode, just like after the global financial crisis. There was a period here where gold just went up week after week with very little corrections, at the same time as the stock market dropping before really falling out of bed in the GFC. And there is a sweet spot in the middle where it pays to actually consider cash being king. But do remember, these periods of cash being king are only very few and far between. So if this is the period we're most likely mimicking now and we're moving into a genuine risk-on environment, what are the signals that will let us know when this time has come? That's what we'll go through right now when it comes to my formula between stocks, gold, and the US dollar. Now this here is a simplified formula when we are looking at the three different asset classes and what needs to be happening to know what the more favorable asset class is most likely going to be. We have cash is king, risk on, and defense, and the way to know which one is which or which one is in play is dependent on what 2 out of the 3 asset classes are doing. So the time that cash is king is if gold is weak and stocks are weak. It seems pretty obvious when you do pull it apart like this, but if both charts are showing signs of weakness and start to change trends, then that is the indicator that both asset classes are going to be falling and it's time to be sitting in cash. You can do this by looking at some higher time frame charts and the things that I talk about on the channel, just tracking the trends, support and resistance, and breakout zones, just like I show you on basically every one of my videos on differing time frames. But the theory does hold true no matter which time frame you are tracking. Now when it comes to a risk on environment, the time that it's risk on is when gold is weak and the dollar is also weak. So this is what I'm looking out for now to confirm a genuine risk on environment when stocks and most likely Bitcoin too are going to massively outperform. When it comes to the US dollar at present, we are seeing a lot of weakness. We had our distribution zone, we are seeing our breakdown at the moment, and we are still looking out for some higher time frame confirmation that this is in fact going to be continuing lower, but I do suspect that will be the case. So the other piece of the puzzle to get to a genuine risk on environment is to see some weakness start to form in gold, and that may be what we are beginning to see in a very, very early sense. Gold is trading at all-time high territory, so we have to tread very lightly here and wait for some confirmation signals of a change in trend, but it goes without saying that a lot of hype has come into the gold market in recent weeks. We've seen calls for $5,000 per ounce or more hitting headlines, and we're also starting to see the chart go quite vertical. So while I'm not calling for the gold market to crash, I am looking out for signs of a slowing trend where it may just actually stagnate for a period of time, much like we saw almost 20 years ago. The gold market topped out and tracked sideways while the stock market picked up and started to put in some very strong trends. So whether the top is in for gold or not, this is a setup I am stalking to get us into a risk on environment, especially if we do see the continued weakness in the dollar. So this signal is something I'm going to stay very close to on the channel for you guys so we can get an insight into when this fully fledged risk on environment comes, if that is in fact what we're heading into. What we're currently in right now is a defensive period. We're seeing weakness in the US dollar and also weakness in the stock market, although I do suspect the stock market weakness may be coming to an end. The tariff crash hit headlines all over the world and a lot of people have started calling recession and financial ruin yet again, as we've seen many times in the overall stock market bull market cycle. But the fact that we have been seeing a weaker stock market alongside a weaker dollar has put the market into defensive mode, and as you can see when it comes to gold, it has most certainly been ripping on up, which is typical in these defensive environments. So for now, the market cycle does remain to be in defense, but as I hope I've explained to you at least clearly enough, the formula is suggesting that we may be switching gears to a risk on environment, especially if the dollar does remain weak. We start to see some weakness in gold and the stock market also changes changing state, putting in a major bottom, then prepare yourself for the defensive period to come to an end and for us to be heading into a risk-on environment just like we saw almost 20 years ago. Quick reminder once again that if you are brand new to the channel and you'd love to get your hands on our Bitcoin report, our Trader's Edge update, and our economic report, there's a link in the description below where you can subscribe completely for free. In terms of the markets and how I'm currently seeing it, I hope you've enjoyed this macro market update. That's all I've got for you in today's video. Wishing you more health, wealth, and happiness. And until next time, I'll catch you then.